if we look weird, give us grace today. We're trying new things. Could you make us like 10 years younger, better looking?
AI does crazy stuff today.
Less stressed out.
It is National Burrito Day, by the way,
I ate such a big burrito yesterday.
We're going to keep this in, by the way.
I couldn't move for like 4 hours, dude.
Tariffs have been the topics ever since Trump took office the first time. Now the second time around, he's doing things, right? Things are actually happening. Where'd you go? Yeah. What kind of burrito?
Rubio's, but they sized it up, bro. I must have got like an XL. It was like a 10-pound burrito, dude.
Rubio's doesn't usually give you very much either. This doesn't. I
only weigh 175. Where does 10 pounds of burrito go?
Poor Brian.
Yeah, he's gonna have to navigate.
And then what's the one slide you don't even have? Can we put that one up?
It is burrito day, though.
Today's National Burrito Day.
We had a little internet glitch there, but we're rolling right back into burrito day conversation. So you know what we're doing when we're not talking about markets. Maybe the greatest food of all time is Mexican food. Rubio's is the top. I mean, I should own. Are they still publicly traded?
I don't like Rubio's as much as you do, actually.
Oh, Lord, man. Get a burrito. Let's deal with the market volatility. This is heavy. Hello, good afternoon. It's Jason Labrum, and this is Financial Detox. And we have a very exciting show today. There's a lot going on as we record. Markets are getting absolutely pummeled. Tariff news and lots of other things going on. So it's going to be an exciting show today. We'll try and get you up to speed and tell you what we think and what we know. In studio with me, as always, is Alex Klingensmith. Alex,
thanks for having me. Yeah,
glad you're here. And we're trying to update some screens and TV or monitors, cameras, all kinds of action going on here. So if we look weird, give us grace today. We're trying new things,
different angles and whatnot.
I think producer Brian's going to cover up for us. So what do you think?
Yeah, he knows how to edit, so he looks like someone else even probably.
Coverage. I like it. Could you make us like 10 years younger, better looking?
AI does crazy stuff today.
Less stressed out.
Yeah, gosh. Today's a big day. Tariffs have been the topics ever since Trump took office the first time. Now the second time around, he's doing things, right? Things are actually happening.
Yeah, it's wild. What we have going on is wild. People are nervous. The markets are processing information, right? So at Financial Detox, we are here to help you make better investment decisions. We're here to help you avoid toxic advice, which there's lots of it out there, and manage your wealth for maximum impact. There's a lot of meanings behind that. It always comes back to financial planning, helping you have the best life you can, do the right thing with your money. One thing we cannot deny, though, is the fact that there are real emotions attached to investing, and it is hard. Investing isn't easy. Investing well and investing with high probabilities of success is not easy. It is counterintuitive to what we as humans would normally do behaviorally. And that's where behavior finance has actually gained quite a bit of popularity lately in helping people, particularly us as advisors, if we're studying our craft, be better at helping people with their psychology of money and managing the emotions associated with investing, which they are real. When I started in this business almost 25 years ago, I tend to kind of dismiss people's emotions almost condescendingly. It was not good because I would say like, why are you being nervous, or why do you feel that way? And I think it took time for me to grow my own investment portfolio to really empathize with those clients, to go, well, I understand how you feel, right? And maybe just general maturity. But it's very real. The emotions that we face as investors are real, particularly when we are bombarded with headlines that drive sensationalism intentionally to create better ratings and better ad revenue for the media companies that are driving that sensationalism. So hopefully today, Alex, right, we can help people just take a different perspective, maybe a little wider lens, understand things in new contexts, so that our listeners, who are intelligent, engaged people, do not make the financial and behavioral blunders that so many investors do make.
That's right. And we are paying attention more than ever. It's the first time in 2 years really where there's been real volatility, like real actual movement.
Yeah.
You said something right before the show and I was like, oh, I looked it up real quick to make sure, is today one of the bigger S&P drops or major index drops? And it's not even half of the top 10. So like the lowest, number 10 was 1933. I'm looking at a different screen. Down 8.88% was the S&P. So today's maybe 4-ish, right?
Yeah, in a single day, right?
In a single day.
Yeah.
In a single day.
Yeah,
so I think it's good. It's good that we're talking about this. We're going to go through some pretty important kind of things that are actually happening and maybe dispel some myths of things that aren't happening.
Yep.
And then what to do about them as an investor, right?
Very much so. You know, as an indication though of what we do, we have a couple things at our firm. IDA Wealth is our investment management firm, wealth management firm. We're an RIA, registered investment advisor, legally bound to act in our clients' best interest. Financial Detox is an offshoot of that, which is our consumer education and where we get to get on camera here and try and make a difference in your lives and maybe for some of those people who aren't our clients too. As an example, one of the things we're doing in IDA Wealth today, we have several new clients that have a lot of money in cash. Today, we put a lot of money to work. Mm-hmm. Is it the bottom? Don't know. Nobody knows for sure. Could there be some serious other financial impacts due to tariffs? Absolutely. But we do know that historically, time in the market is much more powerful than trying to time the market. So depending on your horizon and your risk tolerance, people also, we haven't gone to this one in a while, Alex. People talk about the markets all the time. Markets. What are the markets? Like I had a client here in the last couple of days who was talking about the market, but they're 30% equity, 70% of their money is not invested in the stock market. And so I said, what do you mean by the market? And they said, well, the Dow or the S&P or something like that. Yeah. And I went, right, but that's a small portion of your overall portfolio. And so that's an interesting concept, is to make sure that your barometer or your metric, whatever you're comparing or digesting on a daily basis, is actually accurate and comparable to your portfolio. Because if you're looking at the stock market, it may be significantly more volatile than your portfolio. Therefore, you could be causing yourself unnecessary stress that you don't even need.
We'll let's dive into like one or two layers deeper in that. So the S&P 500 is 500 US large cap companies. The NASDAQ's 100, mostly tech-ish companies. The Dow's 30 large cap value companies, give or take. So 630 companies. What's happened over the past 2 years, which this is an amazing case study to look back on and reflect and learn from. Most of those companies, most of those indexes, those three indexes are highly concentrated, especially the NASDAQ, right? Yeah. Magnificent Seven, where do they all live? I think they're all in the NASDAQ, right?
Yep. And I mean, they make up, I think it's 26% of seven stocks make up 20, even in the S&P 500, the top 10 stocks make up over 25% of the entire index. So you're not really diversified.
That's a problem, right? Because then when things like this happen, tariffs are forcing these big companies to speculate on what they're going to do to compete in this ever-changing global market now that there's been actual tariffs imposed and more coming in the next few days, right? These big companies are like, their investors are reeling over it. They're like, well, and so if you thought you were diversified and even those three indexes, if that's all you owned or most of what you owned, now you're seeing it move and you're like, what do I do? Well, you should have been diversified beyond just market cap weighted indexes to begin with, right? That's part of our story that we talk about with asset classes and factors. But anyways, we'll go more into that a little bit with the
of all the charts we have ready to pull up for today, the one that I didn't pull up is a chart that talks exactly what you're saying, where if you bought the 9 different sector ETFs from the S&P 500, evenly weighted, versus just buying the S&P 500, how you did better because the S&P 500, and this is over the last 3-5 years, because the S&P 500 is so concentrated, right? Yeah. It's so concentrated, which can be great. That concentration can make you lots of money. That concentration can hurt you. But let's get to the real deal here, tariffs. We're going to punch this right in the face. It's tricky. The administration is, the current presidential administration and the administration is literally trying something that really hasn't been done. There has not been any political willpower to make changes that Trump, like him or hate him, doesn't matter, don't care. We're about investing, not about politics. But he's trying to do things to make the trade balance fair. So if you look at, we have a slide, I think it's 2, Brian, and you can look at just, and we cannot guarantee the accuracy of this, so we're just throwing it up. But it was obtained from what we believe is a reliable source. But these are the estimated tariffs of a bunch of different countries against the U.S. and the associated U.S. reciprocal tariff. So I think it's really important, before we get all spun up in a tizzy about what's going on, is why is this going on? There's a video circulating of Trump in 1980 talking about how we don't have fair trade. And the United States is taking a bath when it comes to trade agreements and negotiated trade deals. And that's still going on today. He's talking about the same thing 40 years later. So this isn't new. This isn't a surprise, but he has conjured up the willpower to try and make these changes. I don't see how anybody can think it's fair that we charge China 34% while they're charging us 67%. Why would we do that? So I agree with tariffs on that premise. I think communication might be the problem, is not enough communication and not enough education around why it's happening.
Yeah.
To the best of my understanding this morning, even as of about 40 minutes before the show, there's over 10 different countries that have already came out and said, we are ready and willing to negotiate with the U.S. on tariffs. We want to have a good, fair trade deal. And so there's already some very positive things happening from this. Who shoulders the burden of these unequal trade deals really becomes the American taxpayer, because our government needs revenue to operate. And if it's getting the short end of trade deals, then they have to pay higher taxes. We have to have higher tax rates.
That's a really good point, Jason. When you think about what a tariff really is in the first place, what we're doing is we're imposing a tax on the rest of the world, right? For doing business in our country. And so those people, in the same breath, they might be really angry about the tariffs and saying we're alienating ourselves from the rest of the world and we're not making friends. And those same people might be complaining that we have a huge deficit and a huge debt burden of trillions of dollars. Well, guess what happens when you have tariff revenue? What happens to that deficit? It goes down. Right? Yeah.
And this is the goal of the administration. They said we are going to cut $1 trillion of government waste through DOGE, which, again, not a political show. We tend
You're trying so hard, huh?
we tend to dance. We tend to dance around politics a lot because it can affect the markets, and it unfortunately is affecting so many people's perceptions of what's going on. And I think it's really important to fill knowledge.
Theory. I want to throw some out there that is kind of political. I'm just going to bait you, man. Check this out. This is a good one, though. I think I think I'm totally on your side.
Alienating friends.
No. But listen. So think about this. This is a hypothetical scenario made up by me. No data to support it. But let's say that let's say that the tariff thing sticks for a while. It's not just a short-term strategy or gamble. It's more of like a longer term. We're actually going to reset global trade. It could bring more jobs back to this country. And so those people that maybe no longer have jobs at the government, for example, that maybe those weren't very productive jobs or they were deemed unproductive, inefficient. Now they have other opportunities to actually help and work and make money for their families in this country, because now manufacturing or other areas, steel, like things that before were not cost competitive with because of the lopsided tariff situation. Now it comes back up to parity and we can compete again with ourselves, basically. Then those people have jobs again, right? And then also, hold on, one more thing. And I know you can't. What if then inflation actually does the opposite, starts to go down, and because rates go down, because the Fed now is motivated actually to cut rates, which is now, that's a real thing. I did read somewhere today that the probability of rate cuts actually happening this year went up astronomically today. Yeah. Right. All right.
You bring up a lot of good points. I mean, the administration. By the way, if you hate the Trump administration and you're Democrat, you should be careful, because he's surrounded by a lot of Democrats in the administration, previous Democrats and current and existing Democrats that are helping craft this. Trump himself was a Democrat for a very long time. but they're not doing this because they're stupid and they want to hurt Americans, despite what Rachel Maddow might be saying. That's not the case. They are doing this because we have very unequal, unfair trade deals right now for America, and that is causing Americans who back in the mid-1800s, we had a zero income tax rate. And today there's people paying as high as 50% income tax rates. So why? Because we ended up after World Wars funding through bad trade deals, the rebuilding of lots of the world and helping other economies grow and expand so that we ultimately could have good trade partners. But eventually that should have equalized and rebalanced, and it never did. So this is a gamble. This is a risk. It takes a lot of willpower to do what they're doing, but the ultimate results could be and should be, and the goal is that we are going to have inflation under control, that we're going to have much more revenue. $1 trillion or more is the goal of potential new revenue to the government, with an additional $1 trillion of cuts to government waste. Nobody can argue whether you want big government spending or small government spending. There isn't a sound-minded person who can argue that we want wasteful spending. We want the government to take our taxpayers' dollars and totally blow it, waste them on unproductive things. Nobody could want that. If you're for big government and you're for a lot of social programs, then you would want efficiency in those programs because you could have more programs and they would have more impact on people.
You want opportunities, right? For jobs and careers and savings and investing, which is where we come in.
So who could be mad because we're trying to reduce government waste?
Because it's confusing. It's all very confusing.
You could be mad about this tact and the style and the verbiage around it. No question. That's frustrating, or could be frustrating.
Yeah.
But the outcome is to bring manufacturing, good manufacturing, and good intellectual IP back to the United States so that we have great jobs here, that we can continue to have the best standard of living in the world, bar none, unconditional, unarguable. And those are things that the tariffs will do. They will end up making it fair so that the next goal of the administration is to have zero income tax on anybody who makes under $150,000 a year. That's awesome. This could be amazing and radically powerful for the U.S. economy. We're bringing jobs back. We're getting rid of violent criminals and illegal immigrants who were violent, and we're creating more manufacturing, and we're creating lower taxes, and we're creating higher revenues for the government. These are the objectives of the administration. Love them or hate them. Those are pretty hard concepts to say, I don't want that. I don't want lower taxes, more jobs, and more manufacturing in the U.S. and fair trade deals.
Yeah. And just talking to many clients over the past just a couple of weeks even, you know what happens, Jason, in these conversations is the administration, let's just use that word, has several different issues or platforms that they speak on. So if you agree with the tariff thing, let's say, because you really understand it and you think long-term and you're agreeing with us on this, but as soon as we mention social issues or some other thing, all of a sudden it's all good or it's all bad. You couldn't just say, well, I really agree with the tariff platform and what might this do for the U.S. economy, but I really hate this social issue. So now it's all bad. That's a lot of what's happening. And the conversations I've been having is people that just don't like Trump, they don't even care anymore what he's talking about. They just hate all of it.
Yeah, they're never Trumpers, right? You're just not even going to listen.
So it's like, I get it because I totally disagree with a lot of his stuff that he says personally. I won't tell you what they are right now, but the tariff thing, I actually do kind of understand it. And there's really good case studies in history that I learned a lot about yesterday and today in preparation for today. Was in 1930, it didn't work. It forced the whole world into recession because everybody kind of lost together. We rebuilt, right? This country became even stronger because of that collapse, but it was tough, right? In 2018, 2019, it did work as far as I'm concerned as an investor, right? That really did work because it was sort of this short-term strategy. It was short-term pain for a longer-term gain. And look what happened since 2018, 19, when China and the US got into the trade war. Again, it's leveraged now, just like you mentioned, Jason. There's a lot of really important things that are going to come out of it. It's really volatile. Like there's things changing every half hour right now.
Yeah, it's fast moving for sure. But so what do we do when we think about that, right? Let's get back to the investment. So there's a lot going on. Yeah. You can love it. You can hate it. You can disagree with it.
Should have bought CVS.
Yeah.
CVS, yeah.
CVS is the biggest individual stock. I think winner last quarter. Tesla was the biggest loser or one of the biggest losers, right? It's crazy. No, I'm just kidding. That's not what we're telling people. We're not telling people to do that, right, Jason?
I mean, I would start allocating funds if I had a lot of money on the sidelines today. But people, let's look at the power of long-term markets. When you look at the volatility that we're experiencing today, it becomes a small blip on the radar over the longer term. And so we would advise you to try to decouple the emotions and what's, again, you're reading on TV and hearing about it, and think as an investor. Like, do you want to buy, if you're investing in something, do you want to buy it when it's expensive, or do you want to buy it when it's cheap?
On sale.
And so, yeah, if we get an opportunity to buy things 10, 15, 20%, 30% sell, probably a good time to deploy money. We're not predicting the bottom of the market. We don't know how things are going to shake out, but I do know that over the long term, we do believe markets are going to go higher, because it's like a funnel. And if you take a funnel and you have new innovation and new technology going in the top of the funnel, and you have the garbage and the junk kind of falling out the bottom, and with innovation and technology and growth, that funnel, the value of the things inside that funnel tend to get bigger and bigger and bigger over time. So,
well, and how about the opportunity for all those companies in the US that weren't as competitive because the Mag 7 or whoever had gotten so big, it was so difficult to actually compete. And now the playing field is, I don't want to say it's leveled out, but it certainly has shifted and changed. Like companies that weren't as competitive before because of tariffs, let's say, now they all of a sudden have a chance. And those, you want to own those companies too, because holy cow, they could actually outrun and be the next Mag 7 or whatever you want to call it next.
Yeah,
right?
Exactly. Well, and you're seeing that shift in the markets, right? If you look this year, the NASDAQ, the tech stocks, and the Magnificent Seven, those are some of the biggest losers so far this year. Whereas you go to international stocks are some of the biggest winners this year. So total flip of what's going on. Really hard to predict and time that type of market move, which is why we've always been a proponent of, control your lever, decide how much volatility and risk you're willing to take, and then build a portfolio that delivers the expected and desired outcomes, but not trying to pick one sector. Over the long term, you look at what the S&P 500 has done, 10.5%. This chart's going back to 95. You look at other asset classes, they just have not done as well. You look at bonds and gold and stuff, they have not returned what the equity markets have. So for being an investor and being somebody who's willing to set your emotions a little bit aside, or at least control them and control your behaviors. I guess you don't have to ignore your emotions, but you do have to control your behaviors. The outcomes of investing can be really phenomenal. And that's the point of why we do this. And if it was so easy, everybody would do it and the returns wouldn't be there. It's supposed to be hard. Let's look at our first slide. And a lot of times you'll hear, especially now, stocks are just too risky, right? Stocks are too darn risky. But yet again, you look at the average returns of what you've received for that associated risk or volatility. I've said things that I'm glad Jordy's not here because our compliance, right? But
that's a good way to start.
Yeah, right. No, but you have to define risk versus volatility. And I think it could be conceptually stated that there isn't any risk in a well-diversified equity portfolio. If you define risk in the sense that this could go away totally or go down and never come back. And if you have a well-diversified portfolio, not even the S&P 500, I don't think that works. I think it's too concentrated. But a well-diversified portfolio, I would say it's hard to imagine an outcome where it would go to zero and or stay at zero. It's
impossible for me, by the way. So I'm with you on that, because it would mean that every single one of those companies that all those people work at, millions, our whole country, let's say, minus the government employees, but at that point, what's left? They're all gone.
Everything's gone. And so it's hard to imagine. So is that risk then or volatility? The problem is volatility can turn into risk when behaviors are not in check. I'm not even going to say emotions, because emotions, you can't help it. But how do you do that then, Alex? I mean,
Well,
at
that's
our
what's happening
firm,
today. So
Yeah.
sorry, but I'm like thinking about, so if you look at the red numbers on the screen, whatever screen you might be looking at today, that's people selling, right? Not everybody, lots of people are selling. And so they're locking in whatever they're realizing, whatever gain or loss they have at this moment in time. I don't know what they're doing with their money once they cash it out of that position. And hopefully they're doing what we do, which is where you were about to go. And I'll let you continue. But if you just sell and wait in cash, or if you sell and buy something that's even riskier, gosh, that's scary. And if you don't have a plan that helps you test and retest that every 3 to 6 months, like we do with every single one of our clients that already has this as part of the plan, this was always part of the plan, some volatility in the future.
I think that's the key, right? When you look at a lot of our clients will call and say, "Hey, what are we doing? And what are we doing? This market's crazy." I'm like, "We already did it." What do you mean? What do we already do? Well, when the Magnificent Seven and the NASDAQ and our tech and our growth stocks had done really well over the last several years, we've trimmed profits. And we took some of that money and we put it in more value oriented. We put it in more international positions, which, by the way, are doing really well now. And we bought those back when they weren't doing really well.
Is it because you predicted that, Jason?
Not because I predicted that at all. If I was that smart, I wouldn't even do financial detox. I don't know what I would do.
But why did you know how to do that?
We were fortunate enough to that's a loaded question, but we built systems, processes, procedures, algorithms in order to help us not time the market per se, but time the market, but do it in a way that's not behaviorally or emotionally charged. Instead, it's strategically thought out, and it has a virtual 100% chance of success. If I trim profits when things are at a high, and I have a process to do that, and I add to things that are low, as long as those are well diversified, good investments or asset categories, then I've basically built a system and a process to time the market. Am I going to time it perfect? Am I going to get every tippy top and every bibbity bottom? No way, but I'm going to be close, and we can do that. So,
and I can actually think of 2 or 3 really, really famous people who are famous for being incredible investors that say what you just said in their own words, right? Mm-hmm. Warren Buffett talks about value investing. What is value investing? It's when things are on sale, according to him. Yeah. Through like really complicated ways of looking at things. Dimensional, right? Eugene Fama and Kenneth French, efficient market hypothesis and small cap value and all this. These people have been published for the similar type of thing that you just said, right?
Well, they say it better than me. That's why they're published and we're still here. But
you're published too. Wait a minute.
You're published? I'm published. I think there's at least 8 people who read my book. So,
well, our whole firm has read
Financial
it at this point,
Detox.
So that's at least 30 or so.
Okay, we got 30. That's awesome. One of my favorite Warren Buffett quotes is, "When others are greedy, be fearful. When others are fearful, be greedy." But in the end, what we're trying to do is help people be set free. I see so many, and for 25 years, I've seen so many people confined by stress about the markets, about volatility, about not understanding their portfolio, about not understanding what their portfolio or their investments can do for them. Yesterday, had a meeting with a client who just doesn't really live life to the full potential because they've never had a financial plan that we've just delivered to them that literally shows them the probability of success, stress tested out through the end of their life, that we continue to review and monitor. And this person should be spending more money and they should be having fun. And she's like, "I want to go to New York for a year. I really want to live in New York for a year." I'm like, "You should go." And what do you mean? So I show her on the plan, literally, what if scenario, you're going to New York. Here's this money that's going to cost. Here's what's going to happen. She's like, "I can do that." And I'm like, "Yeah, like go." And then call me in a year, let's figure it out. Let's do something else.
Come back.
But it's really cool. At the end, she's just like, "I can't believe this. Like, why am I living like a hobo?" She didn't say that exactly, but kind of. She said, "Why?" I think she actually might've said that. "Why am I living like a hobo when I could be doing the things I want to do?" I said, "It's got to get set free. You got to have a plan."
Even despite what's going on right now with the markets, literally, because
even despite that, because we had already modeled in volatility. We know through the proper planning, and if you work with the right fiduciary advisor, we know how volatile markets can and have been in the past, right? They've been crazy. And we model in that expected volatility to all of your planning going forward. So when clients are concerned or saying, wow, what are we going to do because of this market volatility? I'm like, well, we already knew it was coming. We expected it. We're not surprised. The markets are supposed to be volatile. That's why there's a reward for being invested, right?
And the hardest part for clients sometimes, especially like right now, is sticking to the plan. That's literally the most important thing they can do, right?
It is, which I think if you pull up the S&P 500 chart, I think it's 5, Brian. This is a pretty cool thing to just kind of, as we kind of come to a wrap here, being short and sweet today. Time in the market versus timing the markets, right? So if you look at this chart, there's a lot on here. And if you're listening on a podcast, you can't hear it. But if you reach out to us, Jason at financialdetox.com, we can get you any of the things we're sharing today and would love to help you. Check us out at financialdetox.com as well. But if you're invested over 20 years, and this is just the S&P 500, again, I think we've said it once, maybe twice already on the show. Let's make it a third time. The S&P 500 is not a great diversified portfolio. It could be a piece of a portfolio, but it is certainly not a diversified portfolio. So there are better results than this by far when you add in some.
We had a crash on Jason.
It is National Burrito Day, by the way, totally.
I ate such a big burrito yesterday.
We're gonna keep this in, by the way.
I couldn't move. I couldn't move for like 4 hours, dude.
You jumped. You were one day early, man.
No, I didn't even eat dinner. I was like, dude, the burrito from lunch is just done.
Where'd you go? What kind of burrito?
Rubio's, but they sized it up, bro. I must have got like an XL.
Yeah. I don't know if they have those.
It was.
We're just gonna randomly cut into this.
We should for sure. It was like a 10-pound burrito, dude.
Rubio's doesn't usually give you very much either. This doesn't
I
make
only
any sense.
weigh 175. Where does
you
10
tip her
pounds
first
of
or
burrito
something?
go?
Or him?
It's crazy. It is burrito day though.
Today's National Burrito Day.
That's
According to
special.
something that showed up on my phone this morning. I don't know.
Okay.
All right. We're rolling. We had a little internet glitch there, but we're rolling right back into burrito day conversation. So you know what we're doing when we're not talking about markets. We're talking about how big your burrito was from earlier.
Well, turn off your phone and stop looking at the markets going down. Go get a burrito.
Go get a burrito for burrito day.
Yeah.
It comes full circle.
Yeah.
It does, which it should, right? I mean, we're all human here. We need burritos. Maybe the greatest food of all time is Mexican food. I mean,
Burritos
is it
specifically?
Rubio's is the top. I mean, I should own. Are they still publicly traded?
I
should
don't like
own more.
Rubio's as much as you do, actually. It's way better to go to the one down the street that's like the mom and pop hole in the wall. Come on.
Los Primos is so good.
Any of them.
But their burritos are a different level. I mean, they're even bigger than Rubio's.
You're going to have to cut it in half, yeah.
Oh, Lord, man. Get a burrito. Let's deal with the market volatility. This is heavy.
It is lunchtime.
Oh, that's why we're talking about burritos.
I'm hungry.
Getting hungry.
Yeah.
All right, so if we're gonna wrap this show, so we've been talking about burritos and enchiladas. No, we're talking about tariffs, the impact of what's going on. It's real, right? There's a lot going on. Markets are processing a lot of information. The bottom line is, the longer we're invested, the better we're going to do. When you look at diversified portfolios, there's this is the chart we have up is literally just S&P 500. Again, not a totally great diversified portfolio, but a good piece of a portfolio. 15-year periods, 100% of those periods were positive returns. You never had a negative return over 15. 92.3% of 10-year periods, you were positive. And over 80% of 5-year periods, when you break that down to a 1-year period, it's like a 74% chance of making money. The odds in Vegas, best case, if you play craps perfectly, you can get to about a 50%. Blackjack, you're about a 49.
You talk about this, and we have other data, not available today, but globally diversified, adding in private alternatives of maybe 20% of the total allocation, and the odds go up even more, right? The
odds go up significantly if you add a little bit of fixed income, if you add a little bit of alternative investments, and if you add international and small cap. I don't have that number, but I would dare bet that there's not a 5-year period that wasn't positive. If
plus
you
the
had
rebalancing, like tolerance band rebalance, all that along the way. It's which
So
is what we do.
if you're invested, you're going to do well. The key is to figure out how you should be invested. How do you figure that out? You got to look at your personal plan and cash flow. And you got to figure out, here's what I want to do. Here's what I'm trying to accomplish. Here's my temperament, my own personal psychology of money. And you structure a portfolio that is custom and tailored for you. And when you do that, days like today won't send you, packing and making big changes in your portfolio, because you will have known there's going to be volatility. You know how much there's going to be, and you can handle that and expect it before it happens. So therefore, there's no surprises. In the meantime, look up some of the positives of potential tariffs and try to understand what the administration is ultimately trying to do. Again, love them or hate them, it doesn't really matter. There's fundamentally intelligent thoughts behind what is happening. Now, whether or not that comes to fruition is to be determined. We'll see if it works or if there's adjustments. I do know that with the bipartisan people advising the current administration, I think that they are very willing to pivot if something doesn't work, and they're getting lots of input from wickedly intelligent people. I think we have the best chance that we've had in a long time of increasing manufacturing and jobs in this country and continuing on the wonderful standard of living we've created. And I mean, we do live in the greatest country that has ever existed. And I think it's important to be proud of that and to recognize that and try and find the positive in things, because there is lots of positive. Today's crazy. If you need help and you want to get a financial plan that will help you avoid the great behavioral blunders that so many investors make and have true financial peace of mind, then we invite you to check us out at financialdetox.com. Lots of good information there, other shows that we've done, and we have absolutely awesome financial advisors and certified financial planners and tax team all here to help you make great decisions with your money and avoid toxic advice. So we are happy you tuned into the show today. We hope to see you again on other shows. If you don't mind giving us a subscribe, a like, tune in, and we'll talk to you soon. Thanks for the opportunity. This is Jason. It's Financial Detox and
Alex Klingensmith.
See you next show.